simpler processes, higher risk in terms of lack of a comprehensive ERP, which is end-to-end, right from your CRM to supply chain to your financial reporting, all integrated. You don't get that environment. A lot of manual activities, a lot of instances where an individual is performing more than one function. So that's one part, sort of one category of companies. The second is larger listed businesses with more complex operations, higher risk from the operating area of operating elements of the business versus purely just financial elements. And third is India operations of global companies which already have a certain degree of matured processes, but the India operation scope is now in an environment where it's more of investment versus where you are in terms of controllership. To take all three, in sense, all three require preparedness for internal financial control. Global companies or listed companies have a little greater ability to demonstrate it, and smaller companies are less prepared to demonstrate it. But this gap can be filled in 2 or 3 ways. So the first part is documentation. Like SOX, one of the biggest requirement SOX created on companies was need for proper documentation, where you are able to demonstrate that the processes which you adopt as a company, you communicate and you follow in a standard fashion. It cannot be people dependent, which varies from an individual to individual. As a stat auditor comes and tests a process, for example, and if there are 3 different variants to the process, all 3 of them cannot be management supported, approved processes. Thereby, the documentation is very clear requirement as to what is the accepted processes, what are the accepted thresholds that management has defined. So first tick in the box for you is the documentation in terms of requirement for any company. So when I say documentation, for example, finance and accounting process, you have to see whether for critical areas, let's say even an MDM, how does customer master, vendor masters, item masters, all these get created, which have some implication. Is there control over the master control process? Is there a documentation on credit policy? Is there a clear segregation of duty defined for manual environment? Is there a closing calendar defined in terms of all the activities that I need to do or my accounting team needs to do to close books? Is there for financial statement trial, evaluation, study, for consolidation, if I'm using consolidation software, what are the controls that I put in place? So this is one aspect, is the documentation. Second aspect is the lines of defense. Is if a risk exists, is there a control defined, mitigating control defined, and what are the layers through which I've taken it? So as I mentioned previously, the one layer is your entire mechanism of policies, procedures which you lay down and enforce, train people to ensure that as a practice non-compliance don't happen. The second could be questionnaires which you ask businesses that whether they are performing their control functions accurately. And third is internal audit. So you have to evaluate that whatever you define as your key financial statement risks or internal financial control risk, have you sort of as management conducted some degree of assurance or testing before the stat auditor works? The stat auditor literally comes after the 3 lines of defense. Third part is the demonstrability. If you cannot today say that I've created a credit policy which just sits with X individual, Y individual manages credit in X location. It has to be a document which has been comprehensive, it is adapted by the right level within the organization, it is formalized, it is rolled out. There is some mechanism to keep it alive, so it's not that you pick up a credit policy and it's 2 years old and you give it to an auditor where he says that your basic threshold materiality of, as I look at your financial statement has changed while your credit policy is 2 years old still. aspects like that. So that demonstrability of the policies and procedures and the control mechanism is very important. So lastly, these are the expectations from management again. To reiterate, documentation, how am I taking the controls through lines of defenses, and how am I able to demonstrate to auditors that I have laid down some internal financial control standards. I will conclude the discussion at this stage, and we will start again for any Q&A that you have. We have received some question and answers, and in the process of receiving more Q&As, and we'll move with the team and answer the questions in a short while.
Alright, so coming to some of the important question answers which among us, the two of us, we will take up. First notable question, which is, can you please differentiate between the second and the third line of defense that we spoke about for the CFO and CEOs to comment upon? So the second line of defense is different from any controller function which is not the internal audit. Internal audit is a third line. Any controller function which is operating as a part of the management group, but not internal audit, but which verifies, and its main business is to basically challenge the business and verifies what the business does and give an independent assurance to the CEO and the CFO. That is the second line of business. So you would have controller functions like finance controller, or a reporting controller, or a risk management head, or a quality control function. That would be typically second line of defense. There is one question which, Robin, you may want to answer, which is, does the IFC replace the internal audit?
Thank you. So, good thing is, this is something which I addressed also. That IFC in itself is a much wider requirement. If you see the responsibilities on the board as well as the auditors, for the board, one of the tools or the levers for board is to get assurance is an internal audit function. As Kartik Radia mentioned very clearly, there are various lines of defense, and internal audit is just one of those lines of defense. It does not gets replaced by IFC. It becomes an integral part of IFC. And the advantage that you get now is that now you are doing internal audit with a specific purpose. For instance, in a financial control, financial reporting area, you cannot say that if it's a material area, I will do internal audit once in 18 months or 24 months. Because at every 12-month period, you have to form an opinion. So, to summarize, that internal audit is a component of a comprehensive internal financial control.
Robin, one more question for you from a technical standpoint, which is a question come from Mr. Vaibhav said. Can the director of a private limited company, although is not mandatorily required, can he make a voluntary disclosure under Section 134 that there is adequate internal financial reporting framework? Can he do so, even though it's not mandatorily required?
The elaboration for compliance with internal financial control, where you're saying that I'm doing it much more comprehensive, operating controls, it is required. You can make the statement, but you can make it under Rule 85 at your director's report. see, anyway in director's report, any private company has to expand, and that is a requirement. We don't envisage that a private company will have a section for director's responsibility statement, because then there are various other elements of the various director's responsibility statements which are much wider, right? So now if we see an end state where subsequently when private companies, just to take an example, risk management, which my colleague Kartik Radia is an expert here, that even risk management also is becoming a requirement for all companies. Now, if director's responsibility statement of more than one area or substantive areas become relevant for private companies is a possibility. As of now, director's report, in its director's report, it can be expanded. If you pick up some director's report for this year itself across businesses, in certain cases, the board themselves have mentioned that it exists in terms of financial statement. They've also mentioned what are the various initiatives that they've taken to make it comprehensive, like vigilance mechanism or whistleblower.
So that it will give a value addition to their company's disclosures, in fact. So from that point, we can, if it's possible, though it not be compulsion, but our policy show motto if they go for disclosure.
Right.
So good governance or good corporate governance.
So leading private companies, especially those who are part of global entities which have private operations in India, where we are interacting with, right? So they also want to expand their IFC scope beyond financial reporting and to operating reporting, because one benefit IFC will give is everything under one umbrella from a controllership perspective. You don't have to run 10 different siloed operation versus one single integrated.
Robin, one more quick question for you, which is a technical question. Like, if the company is already complying with the US SOX requirement, is it all, and is there anything that they can leverage from the SOX, like documentation which is already existing? And to what extent then we need additionally to cover the entity level controls, in the case you are already SOX compliant?
Okay.
90% will cover everything.
Okay. So, couple of things. First of all, what we see is US SOX is fairly comprehensive, and if you try and map, so US SOX has 5 components, it has 17 principles, and that is further broken down into 77 points of focus. If you look at the criteria under SA 315, which has been guided by the institute, that also has under 5 component laid down a lot of parameters with about 18-20 principles which have been laid down. Now the question is that if you're, so the guidance note has just come out, and it's the debate that we're going through, that I don't think a company which is following a COSO framework again needs to go ahead, change and follow a different framework altogether. Because the parameters, for example, I'll just give you an example, code of conduct, responsibility authority matrix, SOD DOA, HR policies, responsibility, performance evaluation, MIS, a lot of the parameters which we defined as entity level requirement for COSO, and today when I pick up the new guidance, that hasn't changed. Maybe 3-5% changes. So if you are following COSO and if you are able to demonstrate that the requirements of the key criteria are being addressed, I think that should work.
So there are a couple of questions which I will take up. One of the things is, what additional steps does internal audit department, the third line of defense, have to take in the new scenario of IFC, especially in highlighting management about internal controls deficiency? So the role that we are recommending for internal audit, which largely is an independent assurance function, not just financial wise but even for the operating elements of the business. Internal audit is supposed to go into the operating areas and the operating parts of the business to ensure the coverage as per what the board expectation is and so on. The additional role that we are recommending for internal audit is to include the IFC testing also, along with the regular scope of work that they are performing. This will give the board the independent line of comfort. So there is an independence line there where the board is getting a lot of details from the CFO and the CEO through the CFO and the CEO from the controlled self-assessed results. This is the line which internal audit will independently report and say what controls are operating and how they are operating and whether they are effectively operating or not. So that is the additional role that we are suggesting for internal audit department vis-a-vis the IFC testing work. It is upon the board to give this particular additional role to the internal audit department, or whether not to give, but in which case the board will still have to do a checking or make sure that there is adequate verifiability through an external auditor, maybe not statutory audit because that is they are reporting to the shareholders directly. So maybe an external consultant or who is appointed as an auditor to review whether the controls are actually operating. Ideally we are saying internal audit because that's independent. It's an already independent function that can be utilized. So that is a role that we recommend for internal audit to perform the third line of defense testing. The next question is, what is the difference between COSO framework, revised guidance note of the institute, and PCOB auditing standard 5? So see, particularly each of these frameworks or guidance notes or auditing standards, they are drawn up to guide a particular aspect of the functioning, either for the internal controls, like COSO is for largely about a framework which is well recognized internationally for internal controls. PCOB auditing standard 5 is something which is an auditing standard for the auditors of listed companies to follow when they are reporting on internal controls over financial reporting as required in the US. PCOB stands for Public Company Accounting and Oversight Board, and that's an independent board which has issued auditing standard 5. So that is what PCOB auditing standard 5 is. PCOB auditing standard 5 has to be adopted by the auditors while they are doing audit of internal controls over financial reporting as required in the Sarbanes-Oxley Act for the US listed companies in the NASDAQ and in the New York Stock Exchange. The revised guidance note of the institute is purely an ICAI guidance note to the members of ICAI, Institute of Chartered Accountants of India, and that is to be followed by the auditors while performing their attest function for internal financial controls, which is required as per Companies Act section 143. So very typically COSO has nothing to do with a statutory auditors auditing standards, etc. It's a framework for the management to follow. Versus PCAB auditing standard 5 issued by the US PCOB, and versus the revised guidance note which is issued by the institute for guiding the members of ICAI. So auditing standard 5, there is a lot of reference to auditing standard 5 in the revised guidance note of the institute. But so there are a lot of common elements which are getting covered in the revised guidance note revised guidance note, which are the elements coming from PCOB auditing standard 5. But they are having very different objectives issued by two different institutes. Robin, if you want to take up the next question, how to report for small private companies? What is the reporting for a smaller one-man company or a private company?
So I did touch upon it. The three environments, we spoke in terms of if you're a smaller company, what are the things you need to do. So let's put it this way: for a small company, your core requirement or an area of gap is financial reporting. If you're not able to show internal control over financial reporting, now you have a gap there. So it is important that the first thing you need to do is define the material areas for you in terms of both process as well as your financial statements. Ensure that you have basic documentation in some form to substantiate the process which is there. Again, it is an evaluation of the process. understand IFC is not saying change your process. IFC is not saying do it differently, that you are doing in a manual environment, you must do it in an IT environment. It is saying that as long as it's happening with a certain control, which has got the buy-in of the management, which has got buy-in of the functional heads, that is what is important. So documentation becomes a key requirement, first I mentioned. Second is what kind of management or some kind of assessment that you're doing through an internal audit partner, Big Four or otherwise, doesn't matter who it is. Are you doing some kind of an assessment or testing of some of those key controls? That's the second layer, which is the line of defense. And the third requirement is the demonstrability. That as someone comes in, your policies and procedures are clearly available at the right. It is not sitting on someone's desktop. There is a mechanism through which all the policies and procedures, even could be in a shared drive. It is shared. There is a buy-in. An approval has been received by even that one person who is the management personnel, and it is available for the organization. So, see, if you are not able to demonstrate, if I give an example, a control has to exist throughout the year. Unless you are able to demonstrate that a policy that you have rolled out existed and got communicated throughout the year, you cannot demonstrate its existence throughout the year. So I think these are the three things, as I said: a line of defense, how you evaluated it; documentation, that it exists, and largely demonstrability.
Again, still another question for you. What exactly the auditors will come and see during the audit of IFC? What all the company should be ready with? I think while we have covered this, maybe you want to just briefly touch upon
I
this.
specifically covered it because I was validating some of those questions. So which I covered specifically is, see, the auditors would not, so again, auditors have dual tasks now. One is the audit of the financial statements and commenting on the reliability of the information. And the second part is their reasonable assurance of internal control over financial reporting. You should be able to first demonstrate that there are some basic key principles and guidances given, which is compliance with GAAP. Are accounting records accurate? Are your policies, procedures clearly defined? So that's one layer. You should be able to demonstrate all of those exist. The second is the criteria or the components which have been guided by the institute. How have you implemented those? That you should be able to demonstrate to the statutory auditor to the extent it's applicable for financial reporting. For example, delegation of authority, segregation of duty, financial policy procedures, that you should be able to demonstrate to the auditors. And lastly, their requirement is something like financial assertions, which is based on what they will evaluate. So the entire linkages to your controls, to your financial statements through assertions or materiality is something you should be able to demonstrate. That these are my material accounts and I have created controls for this.
So another question which I will pick up, which is how system-driven GRC engine helps the corporates to strategize the compliance requirements. As auditor, can we help the organization to build pre-audit checks for better exercise of internal controls? So system-driven GRC, as I already mentioned that for internal financial controls, the usage of tool would be very important in the longer run to automate and drive efficiency in the entire compliance management process and to drive the effectiveness, basically to ensure that there is adequate effectiveness of the internal financial controls. So it is only going to help us to do it in an automated manner through a workflow, and that will ensure the overall efficiency and effectiveness in the whole process. But GRC, along with not just being a controlled self-assessment tool, is a lot more bigger tool which will help you achieve your governance objectives, risk management workflow, and compliance objectives. And a lot of times, we see companies in today's age and environment, particularly some of the large multinational companies and some of the large Indian companies as well, and even some of the medium-sized companies which have a better governance management process, they go for a consolidated, integrated tool for enabling the whole GRC exercise, governance, risk management, controls and compliance exercise. So that certainly helps us to drive efficiency and effectiveness in the whole process of IFC. Can auditors help the organization to build pre-audit checks for better exercise of internal controls. So auditors, of course, by the virtue of their role, do play a role of giving management adequate recommendations in the process, and therefore help them to build up the pre-audit checks as a part of GRC requirements and as a part of the ERP tool also. The earlier question, the one more question which is around the ERP systems, whether the pre-audit checks could be there in the ERP system. Definitely, in fact there are those application controls which are there as a part of ERP that can be well leveraged to ensure that there are enough internal financial controls, and to the extent you have more business application controls, you will have less manual controls, and to the extent it is driven to the system, that is certainly going to enable you to ensure that there are no points of failures into the entire compliance exercise. And again, a linked question to this is, which is a very important point to discuss. It's a hot topic. The entire IFC topic is hot, particularly in the light of the requirement of 2015, 31st March 2015 certification which is required, and the now revised guidance note which has been issued by ICI. That very typical question which we get faced with, can the statutory auditor of the company help to develop the IFC framework for the company? A very important question. Now, to be answering that question very straight, statutory auditors can give kind of recommendations and can do a critical review of the existing framework. But when it comes to financial controls, if the statutory auditor is to go out and do a full implementation of all the financial controls, what would in turn happen is, he is going out and developing those controls on one side, he is also opining on those controls effectiveness during his audit. And therefore there is a very inherent conflict if it is done in that manner. However, there are ways in which if there is a critical review to be done, then that is fine, because anyways a recommendation, an auditor can very well give a recommendation. But if it has to be a full-fledged framework and a complete exercise of development, then there appears to be an apparent conflict, and there has to be a careful application of the entire scope as to what scope can be done and what scope cannot be done, in order for the statutory auditor to maintain the independence. Any further questions? So we wait for a few more questions to be downloaded.
लैपटॉप पे ले लेंगे, ठीक है, निकाल सकेंगे.
So Robin, while this is happening, since you are undertaking this compliance effort all across, in terms of the approach which is getting followed, there are questions which the board of directors etc. have. What is your particular view, while you have covered in your session mainly the technical matters related to statutory auditor side, but are there any board perspectives that you would like to bring up to this group for them to have enough insight on what is a board perspective? Typically what kind of let's say some of the multinational companies or highly governed and well managed companies, how do the boards of those companies look at it? What is the board's perspective on this entire exercise?
Thanks for this question, Kartik. So if I look at, so that it's more dependent on the various type of companies which are categorized. If it's a globally listed business, which already is following some kind of a framework within India, they already have mature processes dictated by Indian compliance requirement environment, dictated by global requirements wherever they are listed. Their challenge has been that there aren't too many siloed compliance activities. There are risk registers which have operating, so when I'm talking about risk registers, these are from risk management, but there are operating and financial controls there. There is some self-assessment which is happening for compliance and financial reporting. There is internal audit happening. Their challenge has been, how do I integrate these and create one framework? So that is one thing. If you are a large organization, if you are running siloed controllership activities, what is an important activity is how you ensure that you integrate some of this and not go to the functions of the business repeatedly. Second part is what our small companies are facing, are asking questions in terms of, and just to go back again to listed companies. Indian large listed companies where you are driving IFC purely as an internal control over finance reporting, check in the box exercise, they are, it's another compliance activity for them, it's an additional compliance activity. For them it's not as exciting as where you include operating controls and make it a more of a comprehensive again framework. Where you're giving them a point of view on operating control risks across their business processes. Wherever we have done a wider scoping, operating controls, financial controls, or compliance controls, versus where we have done purely financial reporting controls, the excitement of the businesses, the excitement of the leadership is very different. So that's what you need to evaluate. As far as independent auditors, independent board, independent sort of directors, are concerned, some of their questions are around first, whether in a group of companies, whether there is a control operating at each of those entities. Now you could be in a conglomerate where an X business is at a 2,000 crore turnover and a Y business is at a 150 crore turnover. And since there is an operation of IFC at each entity level, is there IFC operating at both of them, and can the board or the management assure that that is operating? So that's one of the controls, one of the responses. The second response of independent directors is, as you go through the cycle, what you call as very basic financial reporting controls, let's say payroll controls or something which are more low or moderate level, those should be done away by now. I mean, if you're a matured operation, those low or moderate, even though as you create a materiality and say these are not as important to me, the flip side of it, they are saying that even if it's not important, it's too small or it's too easy a control not to address and get closed. You should not have exposure in areas which are in itself very basic areas in terms of just process. For example, again, payroll, end-to-end payroll inductions is such a basic process. If you have an organization of certain maturity, you should not have gaps there. In terms of smaller companies, it's more to do with, it's more the least, how much effort they need to put to get there. And the management is asking us that we've been doing this internal audit. As we captured that question, is an internal audit enough? And that's why we've been explaining to them that that the idea is more lines of defense, idea is documentation, idea is demonstrability.
Another very important question which has come up is, in fact, the two participants who have asked this question, to what extent is this 5% and above and 3% and above limit, is it based on practical experience or is it defined somewhere? So we go back to the materiality standards which have been defined by the institute. So there are places where of course the materiality depends upon the individual professional judgment of the auditor concerned. But there are places where there is a reference to some sort of indicative percentages for materiality, some kind of guidance which is available in some of the resources of the institute, as I already mentioned during my coverage. 5% is what is something which has been outlined in some of the resources. Applying a threshold of 5%, but then again there is a haircut to it, which is some 30% haircut applied. It comes to something like 3.5% of your profit before tax, and you can take variables there. But that is what is the materiality number that we are looking at profit and loss account, and there is some guidance available.